but I wanted to pull on the thread that we were discussing earlier. And I heard you on a recent podcast with one of your researchers, Dominique, and she was saying how she puts it at 50%. Her base case is now that in the next 12 months, we're going to have some form of recession. So I wonder if you might speak to some of the leading indicators and some of the parameters that she's looking at to make that type of assertion. And with that in mind, the whole conversation about tightening, does that sort of suggest that Powell and team might just be walking into yet another policy blunder?
No, that's a good question. Yeah, I mean, first of all, thematically, yeah, I think for me, it's as a markets person, I always like to think about the next big theme, and that's hence this conversation with Dominique and our team. So last year or two, it's been, inflation. Everyone's been talking about inflation. And even today, inflation is the big topic. But for me, the story is really recession. That's the next iteration of this all. If you just fast forward everything, the next move has to be a recession. I mean, the question is just timing, and how soon will that happen? And so I think for me, the inflation story is really, there's huge amount of ink has been spilled on inflation. So I feel like every side of the argument on inflation is well known, but the recession story isn't well known. So for me, the thing I'm just focusing on intensively this year is recession, and trying to understand how a recession could happen. Now, to start with, if you just look historically, like over the last 30, 40 years, you find this interesting phenomena that whenever you have a Fed tightening cycle and rising oil prices, almost always you get a recession. Whether it was coincidental or not, that happens. So 2007 oil shock, Fed was tightening, and then you had the recession. 1990, the same thing happened. 70s, it happened numerous times as well. Because what you're doing there is that if the Fed's raising rates, that's tightening policy. Just costs go up in different ways. It's just harder to get things done. And oil is a big input, cost. Effectively, it's like a tax. So we have that double whammy now. And from the start of the year, if anything, everything's accelerated. The Fed's becoming even more hawkish and oil prices are going up even more. So the background, I think, is very conducive to some kind of recessionary dynamics. Then in terms of the specifics, the key thing for me, if we take the US as the example, because Europe is probably easier to see a case for a recession for Europe because it's, it's not energy independent, but the US is the more interesting one. The key things for the US have been, we had this big binge in goods consumption in the US. Everyone, you had in 1 or 2 years, you had the same amount of goods consumption growth than you had in the previous 10 years. So a massive over swing to one side. That's starting to fall now. And so the idea was that the service side will pick up the slack. It will really start to pick up, and it hasn't. It's recovering, but not dramatically so. So that tells you that there's something, the other part of the engine isn't working that well. So that's kind of a bit weaker. Why is that overall? It's partly, I think, to do with this things we were talking about the labor market that's a bit weaker than we think. But fundamentally, so if real wages are falling, that's a problem. It's just harder to get things moving. Then on top of that, if you look at the inventory cycle in the US, there was a big inventory buildup in Q4 of last year. So basically, companies have been building up their stocks because they were, they had low inventory before, so they had to build up the inventory. Plus, they were worried that they couldn't get stock, so they double ordered everything. So we've had this inventory cycle. When you have that, often that takes away growth from the future because you're building up all the inventory now. And then the other side of this is the fiscal side that we had last year or two. We've had this huge fiscal stimulus in the US, but this year we aren't going to have anything. And so the net effect of that is you have a negative fiscal impulse. You go from fiscal stimulus to nothing. That leads to a drag on growth. And then with midterms coming up, it's unlikely that anything's going to happen. And after midterms, the Congress will probably flip. And so no new fiscal will happen. So you get a negative fiscal impulse, you get the oil shock, you get negative real income. So all of this is basically pushing, the US closer and closer to a recession. So that's kind of the general direction where we're kind of going in. Now, timing wise, what you need to see to time, so this tells me that in the next year or two, there's a very high probability of a recession. Now, fine tuning the timing, the best things to look at are probably, you need to see the PMI numbers start to come down. So when they start to fall much more sharply, that usually gives you a good sign that recession is imminent, i.e. in the next few months. And then you need to see jobless claims really start to pick up, again. So for me, payrolls, jobless claims, and the ISM PMIs are the indicators you look at to fine tune the timing. So the background for me is high chance of recession in the next year or two, and then fine tuning it. You look at these other indicators to fine tune it all. And in the case of the Fed, I think the Fed is kind of running into a blunder here in the sense that they're going to have to over tighten. Then they'll suddenly realize the economy is kind of slowing down sharply. And then at that point, they'll have to decide to pivot back to dovishness, which I'm sure they probably would end up doing, or continue to hike to really wring out any inflation in the economy.